The other point is that there's a lot of criticism in terms of flexibility, that those who feel that mutual fund plus term cover is a better solution say that at least in a mutual fund, if you're not happy with the fund performance, you can exit after, at any point,
Yes.
except for an ELSS, which has a 3-year lock-in.
Yes.
Whereas here, supposing you invest and then you realize in year 2 or 3 that the fund management is not too great, you can't really exit till year 5.
Yes.
Is that something that, how does an investor overcome that? So for example, I've invested, maybe I've put the money in the equity component, and I'm not happy with the way the fund performance is going. What is the way out for me for those first 5 years?
So, actually, as an investor, judging an investment by a year
is in itself not a
counterproductive in terms of you're not looking at the entire cycle of the market. And in a reality, you'll have to give a fund manager a reasonable period of time, or 3 to 5 years time, for it to generate the required returns. Yes, there is inflexibility, but like I say, Indian consumers have been misguided with the fact that this flexibility is working in their favor. In fact, this flexibility is disadvantage, because some consumers which look at short-term 1-year horizon, land up exiting, have not made the required returns, and have landed up burning money and now taken another option to invest, and hence have not given the fund an adequate period of playing his theme over the 3 to 5 years. Every fund manager has a certain outlook towards the market, and he may have gotten it wrong for 1 quarter, 2 quarters, 1 year, but if you give it a 3 to 5 years period, it will play out. There will be mark-to-market return. For instance, if I had to give you, while in regulations we are permitted to show a 4 and 8% BI, and average return for our funds have been upwards to 18-22%.
Okay.
And if somebody were to look at it of a quarter, and it could have been bad quarter based on either the fund management or the markets thanking off, it could have resulted into a bad decision, and it could have led to an exit. Vis-a-vis, if it stayed for 5 years, he would have made a 20% return and a CAG level. So that would have been a far better story to play out. So I would encourage investors to look at wealth creation from a longer horizon, and ULIP 5 years cap is just a cap for you to stay invested. Ideally, investors stay invested for 15, 20 years.
Right.
That's when you will clearly make the value from the markets. And all themes for India are laid out. It's time to bet on India and stay invested. Then exit early, is my opinion.